Hello, this is part 1 of the Chapter 10 lecture series on current liabilities. Let's get started. In Chapter 10, we will discuss the liability section of the balance sheet. We learned in earlier chapters that a liability represents an amount owed. Also, we learned that there are two categories of liabilities, current and long-term. This video will cover current liabilities, and the next two videos will discuss long-term liabilities. A liability must have two characteristics in order to be classified as current. First, the company must expect to pay the obligation from existing current assets or through the creation of other current liabilities, meaning that the company doesn't plan on using long-term assets or creating a long-term liability to pay the debt. Second, the company intends to pay the debt within 1 year or the operating cycle, whichever is longer. Again, a liability must meet both criteria in order to be classified as current. If it doesn't meet both, then it will be classified as a long-term liability. There are several examples of current liabilities, as indicated here: notes payable, accounts payable, unearned revenues, and numerous accrued liabilities, including taxes payable, salaries and wages payable, and interest payable. Let's first talk about notes payable. Notes payable is simply the opposite of notes receivable, as we learned in Chapter 8. Remember, there are two parties to a note, the payee and the maker. We took the payee's perspective in Chapter 8. Now, let's learn about the journal entries for the maker. Remember, the maker is the party that initially receives the benefit and will pay the total due, principal and interest, on the maturity date. Notes payable differs from accounts payable in two important ways. First, it is evidenced by a written promissory note, and second, it requires the maker to pay interest. If the note is due within 1 year of the balance sheet date, then it will be classified as a current liability. Let's look at an example. First National Bank agrees to lend $100,000 on September 1st, 2013 if Coal Company signs a $100,000 12% 4-month note maturing on January 1st. In this example, First National Bank is the payee and Coal Company is the maker. On September 1st, Coal Company would record the note and the receipt of cash from First National Bank by debiting cash for $100,000 and crediting notes payable for $100,000. This note is a 4-month note that originated on September 1st. This means that Coal Company must pay the amount due on January 1st. However, if Coal Company prepares financial statements annually, it must accrue any interest owed on the note up to the date of the financial statements. The interest calculation is the same as what we learned in earlier chapters: principal times rate times time. The principal is $100,000, the interest rate is 12%, and the time factor is 4/12, all of September, all of October, all of November, and all of December. When you do the math, you get $4,000. Coal Company owes First National Bank $4,000 in interest at December 31st. To accrue the interest, it must make an adjusting entry on December 31st that involves a debit to interest expense to recognize the expense incurred and a credit to interest payable to recognize the fact that Coal Company owes $4,000 in interest. When the note matures on January 1st, Coal Company must pay First National Bank. The total cash paid is total principal and total interest. Total principal is $100,000 and total interest will be $4,000, calculated using our formula of principal times rate times time, or $100,000 times 12% times 4/12. The entry on January 1st would involve a debit to notes payable for the principal of $100,000 to remove the payable from the books, a debit to interest payable of $4,000 to remove the payable accrued on December 31st from the books, and a credit to cash for the total cash paid of $104,000. Because no time has passed since we last accrued interest, we do not have any interest expense to recognize in the current period. If the note was instead, say, a 5-month note, meaning the payment was due on February 1st, then Coal Company would incur interest during the month of January and would therefore recognize interest expense in this payment entry. Now let's talk about sales tax payable. We, as consumers, pay sales tax on goods we purchase. This sales tax is income to our state and or local governments. It is not income to the businesses that collect it. Businesses are charged with the duty of collecting sales tax and then remitting it to the applicable government agency. When a company collects sales tax for a governmental entity, it owes that money to the governmental entity. Until the business remits these funds to the appropriate agency, it owes that money to the government. Thus, it has a liability. Let's look at an example. The March 25th cash register tape for Taylor Supplies shows sales of $10,000 and sales tax of $600, meaning a sales tax rate of 6%. The journal entry made by Taylor Supplies on March 25th would involve a debit to cash for the entire amount of cash collected, which is $10,600. The only income to Taylor Supplies is $10,000. It would therefore credit sales revenue for $10,000. The remaining $600 is owed to the government and would therefore be classed to sales tax payable. If a company does not bring up sales and sales tax separately, it must calculate the amount of revenue earned and sales tax collected based on the total cash received during the day. For example, assume that Taylor Supplies rings up total receipts of $10,600, including sales and sales tax. First, we calculate sales revenue by dividing the total cash received by 1 plus the sales tax rate. In our example, we would divide $10,600 by 1.06, which is $10,000. So sales revenue is $10,000. We then calculate the total sales tax collected by either multiplying sales revenue and the sales tax rate or subtracting sales revenue from total cash received. In our example, you would either multiply 10,000 times 0.06 or subtract 10,000 from 10,600. In either method, sales tax collected is calculated to be $600. The entry would be the same, involving a debit to cash for $10,006, a credit to sales revenue for $10,000, and a credit to sales tax payable for $600. When a company remits payment to the government agency, they would debit or reduce sales tax payable and credit cash. Let's assume total sales tax collected in March was $15,000. Taylor Supplies would debit sales tax payable for $15,000 and credit cash for $15,000. Now let's talk about unearned revenue. We have learned that unearned revenue is recorded when a company receives cash before it earns revenue. When the company receives the payment, it would debit cash and credit unearned revenue. When the company subsequently earns the revenue, it would debit unearned revenue to remove the liability from the books, and it would credit the applicable revenue account to recognize the revenue earned. As an example, let's assume Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The university does not earn revenue until the games are actually played. Therefore, when the university receives cash, it would debit cash for the total cash received of $500,000, and it would credit unearned ticket revenue for $500,000. As the games are played, the university would recognize the portion of revenue earned after each game is played, which would be calculated by taking total revenue of $500,000 and dividing it by 5 games. The university will earn $100,000 after each game is played. It would debit unearned ticket revenue and credit ticket revenue by $100,000 after each of the 5 games. Now let's talk about current maturities of long-term debt. Current maturities of long-term debt is simply the portion of our long-term debt that is due within the next 12 months. A company would not prepare an adjusting entry to record the current portion. Instead, it would simply separate the current and long-term portions on the face of the balance sheet. Lastly, let's talk about payroll and payroll taxes payable. Payroll involves payment to employees for work performed. It includes both salaries and wages. A salaried employee will be paid a fixed amount no matter how many hours worked. A waged employee will be paid an amount per hour for each hour worked. Payroll involves calculating 3 amounts: gross earnings, payroll deductions, and net pay. Gross earnings is the employee's gross pay. If you have one waged employee who earns $10 an hour and he worked 15 hours, his gross pay would be $150. In the entry to record payroll, salaries and wages expense will be debited by this amount. For those of you who work, you know that this amount will not be the amount of the employee's check. The employer is legally required to withhold certain deductions from the employee's check. These deductions are called payroll deductions. They typically involve taxes that employers are legally required to withhold from employee checks and subsequently remit to the applicable governmental agencies. Similar to sales tax, these taxes are not income to the employer. They are income to the applicable governmental agencies. Until the employer remits these taxes to the applicable governmental agencies, it has an obligation to do so. The journal entry to record these payroll deductions will involve credits to certain payable accounts to record the employer's obligation to these governmental agencies. The payable accounts include federal tax payable for the federal income taxes withheld, state tax payable for the state income taxes withheld, and FICA taxes payable for the Social Security and Medicare withheld. After the payroll deductions are calculated, the employer will then calculate the employee's net pay by subtracting the payroll deductions from the gross pay. This is the amount the employee will actually get paid. In the entry to record payroll, salaries and wages payable will be credited by this amount. The employer must also pay taxes associated with payments to its employees. These taxes are called payroll taxes and should be debited to payroll tax expense. There are 3 such taxes: FICA taxes, federal unemployment tax, and state unemployment tax. FICA taxes are the employer's share of Social Security and Medicare. This amount will be equal to the employee's share of FICA taxes. To recap, there are 2 journal entries associated with payroll. The first is to record the payroll and will involve a debit to salaries and wages expense for the gross pay, a credit to any applicable payable accounts for payroll deductions, and finally a credit to salaries and wages payable for the net pay. The second entry is prepared to record payroll taxes and will involve a debit to payroll tax expense and a credit to the applicable payable accounts. This completes part 1 of the Chapter 10 lecture series on current liabilities. Now let's learn about long-term liabilities.